You ever see a company drop what looks like really good news and then just watch its stock price completely fall off a cliff? It's a classic Wall Street mystery. And today we're diving into a perfect example with a company called Ultralife. It's a real head scratcher. So in this explainer, we're going to unpack what really happened.
So, on the surface, everything looked pretty solid. The company announced a 13% jump in revenue compared to the year before. I mean, that's a headline any investor would love to see, right? But that number is only one part of the story.
Because on that exact same day, Ultralife stock didn't just take a little dip. Oh no, it absolutely plunged. A massive 17%. So what gives? How does selling more stuff lead to your company's value collapsing? That's the puzzle we're here to solve.
Okay, so this whole story really boils down to the events of one very, very dramatic day. Let's set the scene. It's August 7th, 2025. Right before the stock market opens, Ultralife puts out its big second quarter report. And on paper, that top number, the revenue, it looked great. It screamed growth and strength.
All right, let's look at the raw numbers, because this is where it gets really weird. You've got revenue up 13% to almost 49 million bucks. Awesome. But then you look at the stock price, a 17% nosedive. And look at that trading volume, way, way higher than usual. This wasn't some quiet little dip. This was a flat-out stampede for the exits.
So why the panic? Well, you have to understand, investors live by a pretty simple rule. It's not just about what a company did. It's about what it was supposed to do. The real story is always in that gap, the gap between what actually happened and what everyone expected.
And this is where the whole thing starts to fall apart. See, while 48.6 million in revenue sounds good, Wall Street analysts were actually expecting more, something closer to 51 million. But the real gut punch was the earnings per share, or EPS. Ultralife delivered just 7 cents. The expectation, almost double that, at 13 cents. That's not just a miss, my friends. That is a chasm.
This note from some market researchers at the time just nails it. The company's bosses were out there trying to spin a positive story about the future, but investors, they were in full-on risk-off mode. They saw that huge earnings mess, and all that skepticism just took over. They weren't buying the story anymore.
And that right there, that gets us to the real issue. This was never really about revenue. It was a profitability problem. The market didn't care that Ultralife sold a lot of stuff. It cared that the company wasn't actually keeping enough of the money it made.
Now, to really get this, we have to talk about something called gross margin. It sounds technical, but it's simple. It's basically the pure profit a company makes from selling its products, before you pay for all the other stuff like marketing and CEO salaries. Think of it as a checkup on the fundamental health of the business itself.
And here it is, the smoking gun. In just 1 year, Ultralife's gross margin dropped from almost 27% all the way down to under 24%. In Wall Street lingo, that's a 300 basis point drop. For the rest of us, it means that 3 full percentage points of pure profit just vanished. That is a huge, huge decline.
So where did all that profit go? Well, okay, some of it was due to factory issues and tariffs on parts from China. But that wasn't the main problem. See that giant slice of the pie? Unfavorable product mix. That was the real killer. It wiped out most of the margin all by itself. And if you're wondering just how bad it really was, well, you don't have to take my word for it. On the official call with investors, Ultralife's own CEO put it about as bluntly as you possibly can. He said, "Yeah, that was a pretty crappy quarter." Whoa, when the CEO says that, you know it's bad. So let's dig in. What in the world is this unfavorable mix they're talking about? Well, it turns out Ultralife is really a company with two very different sides to its business. On one side, you've got their battery and energy division. Now, the revenue is up 25%, which sounds great, but it was almost all because they bought another company. Their own sales were basically flat. Then you have the other side, communication systems, and it completely fell off a cliff, down over 57%. And here's the kicker. That collapsing communications business is where they make their best profits. And that, my friends, is the unfavorable mix. They sold way less of their high-profit communications gear. Even within their battery business, sales of their most profitable commercial products to medical and oil and gas companies dropped sharply. The only thing that really grew was lower-profit government work, and that just wasn't enough to fill the hole. Bottom line, they were selling more of the cheap stuff and way less of the good stuff.
Okay, so after what the CEO himself called a crappy quarter, the big question is obvious. Now what? What's the plan? How do you possibly fix this and earn back the trust of a very spooked Wall Street?